What's up, everybody? It's your host of the Mint Tea Podcast, Wyatt Graves. Welcome back to another episode of our show. Today's guest is a GoBro from GoBundance, Andrew Freed. I met him a couple of years ago at one of our conferences, and we've been trying to connect ever since. He is doing exactly what I'm doing, which is scaling a multifamily portfolio. As you know, the premise of this show is that I'm the mentee as the host, and then I bring on other people who I think have something that I can learn from. And so my interviews and my conversations with these guys and women are such that I want you to have a peek behind the scenes of what I'm doing on my journey to scaling my business, growing my wealth, and maintaining a great personal life as a husband and as a dad and as a friend. Today's conversation is all business, though, and it's with, like I said, my friend Andrew Freed from GoBundance, and he's going to talk about how he is scaling his portfolio. So if you're into scaling a business, scaling a portfolio, especially in multifamily, then this conversation is for you. For our listeners, you and I, we just had a little bit of conversation about where we met in a GoBundance event over in Austin. So I know what you're doing and what you're up to, and I want to get an update since we haven't spoken. And I guess that's been a year, maybe 2 years. So tell us who you are and what you're doing.
So Andrew Freed here. And I think at that event, the Austin Entrepreneurial Summit, I got up in front of the whole crowd and I said that the big thing holding me back is leaving my W-2. And I think Matt King called me out and said, hey, if you don't leave your W-2 by this date, we're shaving that beard of yours.
Oh, gosh.
and then the audience proceeded to chant, quit your job, quit your job. Literally like 500 people. I literally felt like I was naked in one of those dreams. But that one kind of meeting ended up pushing me to quit my job back in June, and now I'm a full-time real estate investor. So that was a fantastic event, and I am thankful to have met you there.
Man, the power of accountability, huh? I think that's one of the things that sets GoBundance apart from many other, call it network groups or business groups, right? Is that there's true accountability that says, okay, when are you going to do it? By when, right? And they hold you to it. So that's awesome. So tell us about your real estate journey, your W-2, just a little bit about where you started. I think you started with, if I remember your story right and know my information, you read Rich Dad, Poor Dad, bought a condo, W-2, had a goal. Tell us, bring us back to where you started.
So right up until COVID, I normally did the American dream where I got a good education, got a good job, got a good master's, got a job at a prestigious institution, the Broad Institute of MIT and Harvard, got a nice swanky condo in Boston. Like I essentially made it by all accounts. But, at the end of the day, when I came home, I always felt like empty. I always felt like I was leaving something on the table. And I always escaped to vices that took me away from my goals, be it video games, be it women, be it food, be it anything to take my mind off of my goals. And come around COVID, when we had all the time on our hands, I literally ran out of vices to do. I had nothing else to do besides look in the mirror and think to myself, is this the life I truly want to live? And At that point, I thankfully found Rich Dad, Poor Dad. And in there, they literally changed their mindset on wealth creation. And in there, there's little sprinkles, there's little hints of the power of real estate. So after I read that book, I kind of looked at my net worth, which was $250,000 at that time. $200,000 of the net worth was in this one-bedroom condo I completely forgot about. It literally took me 10 years to save up $50,000. And that was like mind-blowing to me in the fact that I am never going to achieve financial freedom going the traditional route. And real estate seemed like the secret sauce. So at that point, I decided I'm going to go all in, FOMO. So I HELOC'd my one-bedroom condo for $200,000. And I moved to completely to a city I knew nobody in. But what I did know is they had a lot of multifamily. And it was a market I wanted to invest in. It was about 45 minutes from Boston, Worcester, Massachusetts. Started house hacking, got up to 3-4 house hacks, started joint venturing, splitting, 5-6 plexes with 2 or 3 people. Got up to about 30 units after leveraging everything I owned, HELOCs, 401k, promissory notes, business lines of credit, literally everything I could leverage. I had no money left, but at that point, I had all these amazing deals coming my way. And that's when I found the power of how to partner with other people and utilizing OPMs, other people's money. So since COVID, I went from 0 to about 300 doors. And I'm on track to do 500 by the end of this year. That's primarily value add, buy and hold multifamily, and I do incorporate some flips in there. But I do like to keep my flips two multis, so I have multiple exit strategies in case it doesn't sell where I want. I could throw renters in there. It just offers many different options. So that's kind of a little quick synopsis of my journey.
I love it, man. I love it. Thank you for sharing that information. And one of the reasons that I was interested in connecting with you today is that I too am on that same journey of scaling a multifamily portfolio. I've coached with a guy named Jeff Woods. He's been a mentor and a coach of mine for a long time. And he's recently challenged me to leverage AI as a strategic thought partner, not AI that you use to write an email or to make a social media post, but to use it as a coach, as a high growth coach, to share my business strategy with AI and then ask it to serve as a strategic growth partner and tell me where I'm leaving opportunity on the table. Am I thinking big enough? And dude, once I have leaned into that, I have upgraded and changed my goals so that they now include 25,000 doors in 10 years, which is a massive goal, right? So I am hungry to talk to people that are doing multifamily, that's scaling in today's market. So I've got a lot of questions for you. So thanks for your time today. I'm looking forward to what you're going to teach me.
Of course. Over the past year, I've scaled my team because we self-manage about 200 doors in our property management group. I've scaled my team from 1 employee to around 16. So I definitely know, when it comes to scaling and growing, happy to provide any advice on that front, especially things that really help me, grow my team and grow my business.
Yeah, I want to talk about that too. So you have, you didn't say this directly, but you have a property management team that's managing properties you don't own. Yes?
My property management company primarily manages property that I do own.
Okay.
I primarily operate and manage. I do have probably maybe 5 to 10% of the units we manage are other people's units, but they're primarily just like investors or friends that I manage. It's not my profit lever. Yeah.
So what your total portfolio is how big right now?
Well, to be honest with you, I honestly don't know how many units I own. It's somewhere around the 300 range because every single, I just got one other contract I'm selling and I signed 2 more. I closed on 2 properties last week. I'm signing for 21 units on Friday. I'm signing for 7 units next week. So it's constantly changing, but it's currently at about 300 doors.
Got it. And so with 300, I want to talk, if we can, just for a little bit about your organizational chart. Sure. And how you scaled that. That seems to be one of the biggest things that we need in our world right now. Mm-hmm. As we go from, we've got 175 doors, but not all of them are finished because we also do new construction multifamily. Sure. And simple land subdivides. And we've got an RV park that's brand new from the ground up. So we're in this crux of going from a small mom and pop operation to really scaling in all shapes, right? The operational side and the property side.
Totally.
So with your 300 doors, what's your org chart look like? How many employees do you have?
I have about 16 employees. I have an operations manager. I have a couple, transaction coordinators, a couple of VAs kind of feed up to her. I have a finance director that helps put together loan request packages, investor packages. It coordinates between the bookkeeper and our operation, helps with investor distributions. And then we also have a customer service manager that manages all the communications between the tenants. We have 2 property managers that lead up to her. And then we also have a subset of 2 more property managers in Rhode Island that manage that set of portfolio Rhode Island. We also have a portfolio in Massachusetts. We have a maintenance crew that leads up to the property managers. And my partner, I have a 50-50 partner. He primarily manages the front of the house operations, and I primarily manage the back of the house operations. So that's kind of a little taste of my organization. And my biggest tip when it comes to scaling an organization is you can find amazing workers internationally. And people think, I can only hire, entry-level people or low-level people internationally. That is completely incorrect. You can hire people with masters, you can hire people with PhDs, you can hire executive level functions overseas at 30 to 40 cents on the dollar. And that's exactly what I did on multiple occasions. My operations manager lives in Ireland. My finance director lives in the Philippines. I'm sorry, in Colombia. I obviously have a bunch of people in the Philippines that work with me. And my US based people are primarily the people that need to be boots on the ground, like property managers and maintenance crew. But everybody else is kind of international or, yeah.
Man, that's pretty awesome to hear. Couple things there on the maintenance crew. How do you have that divided? You have a maintenance manager. Do you buy a truck? Is these 1099 employees? Do you have a maintenance guy and a helper? What's that look like?
So there's a multitude on reasons why we don't have a comprehensive maintenance crew. Our maintenance crew primarily just does flooring, paint, and minor fixes, right? And we use third-party vendors to do a lot of our unit turns. And there's a multitude of reasons for that. Liability reasons. You don't have to get workers' comp. I don't have to source all the materials. They can do everything, So I primarily use third-party vendors for a majority of my portfolio, and I just find it easier that way. I don't have to provide the infrastructure to them. I don't have to coordinate material purchases. I don't have to do back billing. It gets very complicated very quickly when you have too much integration. So and honestly, my vendors, my contractors are top notch. Like they're all fantastic, and they do great work.
No reason to get rid of them or to bring it in house.
No.
Love it. Do your maintenance crew folks that are on your payroll, are those the people that are handling and having the relationships with the third party contractors doing the turns?
My property managers are primarily doing the construction management. That maintenance crew, say for example, we have a stabilized asset, a unit goes vacant, we need a light unit turn, we'll toss them on there. We use them a lot for maintenance of our current assets, but in regards to quick stabilization of value add multi, we use a lot of third parties because timeliness is key, right? Like I'll pay 20 to 30% above if they can get it done 2 times quicker, 3 times quicker. Yeah.
Got it. That brings me to another question, Andrew, on the value add.
Sure.
Do you guys have a table or a chart that says package 1 is going to have this? Are you that systematized where it says package 1 is light fixture, or package 1 or tier 1 is paint only, tier 2 is paint, flooring, and maybe plumbing fixtures, and then tier 3 is countertops, paint, light fixtures, plumbing fixtures, and tier 1 would yield X number of dollars increase with rent, tier 2 is whatever, tier 3. How are you deciding and then managing from the high level all the way into the field with directing your people on to the extent of the turnovers or the value adds?
So we primarily only have one tier, and we try to bring all of our units to that tier, right? So if we can refinish the cabinets and do granite countertops and do LVP floor, great. If we can refinish the floors, have to do new cabinets, have to do countertops to get it to that level, we'll do that, right? But to address your question, when we come up, do our stabilization plan, in our original budget, we come up with everything we have to do to get it to 100%. And that's incorporated in our budget. And we might not use the whole budget. Maybe some tenants are staying. We don't have to turn the unit to the level that we think we do. But that's primarily what we do. And we also incorporate that with construction money from the bank, because the bank typically funds 75% to 100% of construction money. So I like to budget every possible thing we possibly need. And if we don't use it, great, right? But the biggest thing when it comes to value add multi, in my opinion, is if you under budget and you run low on an operating account, it's going to take you 2 to 3 times longer to stabilize that property because you're penny pinching at every opportunity you can, and you can't move as quickly as you want. Typically for these value add multis, we're stabilizing these properties within 4 to 6 months because we have all the money ready to go, and we have 4 or 5 crews that can just plow through it as quickly as possible.
That's a good point. I'm looking at 280 units right now that have the need for some value add, and it would be the biggest purchase the most comprehensive purchase that we've ever done. We bought 48 units with 24 build-ready pads on it. And so the 48 units really didn't need value add. But the 24 were brand new construction. So that's easy. That's what we do. And then we've bought 18 and building another 24. We've never bought 280 occupied that needed to be turned, right? And so in my mind, it was going to be the slow process. So great little nugget that I'm picking up in our conversation right now is maybe to look at it in a more aggressive light so that you go in and turn over as many as you can on the front side to hurry up and get there, right? So that you could stabilize in a faster way. That's a good point.
Yeah. I mean, if I get a building with 5 or 10 vacancies day one, I assure you, I'm putting 3 or 4 crews on that thing, right? I'm busting through every single unit. I'm not going to give all those units to one crew. Then 2-3 months later, they're still going to be working on them.
Yeah.
Right? So we probably have a good 6 or 7 crews in our back pocket that we could utilize at any moment. So.
Man, that's great insight. Thank you for that. Hey guys, if you've been a listener of my show for any length of time, you know that I attribute a lot of my growth to learning from the guys inside of GoBundance. If you think that GoBundance is a tribe that you might be interested in joining, then reach out to me. Go to WyattGraves.com, connect with me. I'll reach out personally with you and answer any questions about GoBundance to see if it's the right fit for you. Let's talk about deal flow. How are you finding your deals? What's that look like in today? Are you going direct to seller? Or are you utilizing brokers? How are you finding these deals?
So that's the $100 million question. How are you finding deals, right? And, I think the easy answer would be, direct mail, call owners, you talk with brokers, right? That's the easy answer. But the real answer, in my opinion, is you've got to establish yourself as a subject matter expert, and people have to know that you do a lot of volume in your market and that you're very generous with people who bring you deals, right? So, for example, I host the largest real estate meetup in Worcester, Massachusetts, which is the second largest city in New England. I've been on the Bigger Pockets podcast twice. I'm going on there a third time. I've spoken at dozens of real estate meetups. Over the past 30 days, I've spoken at 7 meetups alone. Right? And what's the end result of that? If somebody runs across a large deal and they don't know how to take it down, who do you think they're going to bring it to? The person who's a subject matter expert who will freely give away equity in the form of them representing me as my agent, right? Giving them a commission, or in the form of give them equity for finding me a deal. A lot of my deals are brought to me on a daily basis, and I do not seek any deals actively.
Yeah, that's very good, man. So back to one of the things you said earlier, are you taking down 500 or you're about to take down some deals to bring your portfolio to 500? What's the goal for this year?
The goal for this year is to close on 200 more doors. We currently have 140 doors in the pipeline that we're currently closing on until the end of May or so. I think we're going to take a break. We're going to stabilize that stuff. And then we're probably going to start purchasing again in September or October.
Got it. I know that you do some creative financing and a variety of financing options. Can you talk to me about those different options that you have, which ones you've seen work the best and which ones you like the most, things like that?
Absolutely. So I've done a lot of my deals on creative finance, right? I'll just give you a couple examples. I found a 6-unit in Worcester, Massachusetts for $1 million. Pro forma is $14,000, 8,000 square feet. This thing's worth 1.4, 1.5 all day. Once stabilized, probably needed 60 to 80K worth of work. So I saw it as a good value, and I saw it with the ability to burn my money out within a year, right? So what did I do? I didn't have the money to take it down, but I had it under contract. I knew it was a great opportunity. So I ended up finding 2 other investors to give me 2/3 of the money. And then for my 1/3, I went to friends and family, offered them a 10% promissory note. Give me your money for a year, I'll give you 10%. At the end of the year, I'll return your money. So that's exactly what I did. I took down that property. I took the promissory note, stabilized the property. A year later, we did a cash out refinance. I paid back those promissory notes. That's a quick example of how you can, leverage some creative financing. Another example I've utilized on many occasions is my business line of credit. If you have a business that has a history of tax returns for a couple years, you can go to these small local credit unions to get a 50, 100K unsecured line of credit. And I've utilized that for down payments on properties with the ability to value add my money out later in the form of a cash out Refinance. That's another strategy I've utilized. I borrow against my 401k, right? That's another strategy for a house hack. I've used home line of credits. I probably had 3 home lines of credits. I would house hack line of credit before I left because you can get up to 100% LTV when it's your primary. House hack line of credit. House hack line of credit. And then going back to your point, the most obvious creative strategy is seller finance, right? But, what I will say is finding somebody who does offer a seller finance opportunity at 100% is like finding a needle in a haystack. And I've done many, many, many deals, and I have not found that, or at least found it where it was good terms. So what I like to do is I like to incorporate a hybrid approach, right? So I go to the seller and I'm like, all right, I want to give you your number, but at the price, it doesn't make sense. Would you be willing to give me a 10 to 20% promissory note at this interest rate outside of the transaction? And then at that point, the deal would make sense to me. And the reason why that's so magical is if you do it outside of the transaction, it's not connected to the property whatsoever. Then you can utilize that money for the down payment. You can utilize that money for operating expenses. Once it's incorporated in the property and you combine that with conventional financing, the bank's going to take that debt into account in regards to the debt service coverage ratio, limiting your LTV, right? But when you have it outside of the transaction, it allows you to utilize those in more creative ways.
Very interesting. So I want to go back to the first deal that you took out, the condos. You taking that to the local bank on a 20-year amortization, 5-year term, or you're going some other kind of financing for that?
You talk about the 6 units in Worcester?
Yeah.
It was just a traditional 6-unit multi. It was not condos. But with that particular property, yeah, I would just go to a local small credit union or bank. I would typically ask for 75% of the construction, 75% of the purchase price, and I would bring 25% of the construction and 25% of the purchase price. And that's what we did with that particular property.
Got it. So on any of what's the biggest property that you have?
So like you, I do purchase portfolios. So I currently own a 69-unit portfolio. We've sold some assets off. We had partial release clauses allowing us to sell properties off, which is another tip. If you buy a portfolio, absolutely get a partial release clause so you can sell individual assets off and not sell the whole thing in one foul swoop. I also have a 39-unit portfolio in Worcester that I'm actually signing the papers tomorrow to refi it out. We bought it at hard money at 4.9. We got the rent roll from $48,000 to $72,000 in about 6 months. Primarily, most of the units were Section 8, so a lot of it was as simple as just getting the Section 8 organization to bring it to market. And now we're refining it at 7.9. So
okay, I want to talk about 2 things. First, to finish the loop or close the loop on the financing. Are you using any Fannie Mae, Freddie Mac commercial agency debt anywheres?
I use all small and local portfolio lenders.
Okay. All right. That answers that question. So so they'll finance on a 30-year AM then, some of those guys, yeah? To help with cash flow?
So you bring up a good point. Most investors don't like New England because it's tenant friendly. It's really hard to get tenants out, right? But there are upsides to New England, specifically Massachusetts. And some of the upside is the fact that we have some of the best lending in the entire nation. There's probably a good 200 to 300 local credit unions and portfolio lenders in Massachusetts that loan on commercial real estate. So what does that mean? It means that's an extremely competitive market for lending, and you can get extremely competitive terms. To your point, you can get 30-year AM, you can get construction money, only bring 25% down, right? Like it offers so many ways to make deals work if you know how to get the right financing.
Got it. Okay. So I want to talk about bringing the Section 8 rent up to market rate. On these 280 units, we're looking at the deal now, we're underwriting it. And one of the things that we know is that the rents are under market rent. We've looked at HUD, we've looked at fair market rent, this, that, and the other. I have never done Section 8 housing before, so I'm unfamiliar with how it works. But if the current rent rate, let's just say that the fair market rent is $933 a month, and most of the rents are $640 a month, and some are even under that. Is the process possible, probable, impossible, improbable? Like, what would you tell me in terms of the likelihood of being able to buy these units and then just a $50 per month rent bump is substantial on 280 units, right? Like we go from a $10 million, I don't know, I'm shitting to say these numbers because I don't know them to be exact, but it's a substantial increase in value. And if we get that increase in value, then we get the increase in leverage. We get the increase in leverage, then we get more money to turn the units and upgrade them, right? And so understanding how to make all these, how to play the chess game. How do we deal with Section 8? Is it likely that they go up? Like, do you just tell them, hey, we need a rent bump? And they say, okay, because it's already under market rent? Tell me, I don't even know what to ask. What would you say about that situation? Where should I look? What should I start trying to figure out?
So I think that's one of the biggest misnomers in real estate is that Section 8 is difficult. Section 8 is honestly an amazing way to get renters. Typically with Section 8, you put a renter in there and they do an annual inspection. And then typically Section 8 will pay a portion and the tenant will pay a portion. And with Section 8, you normally have the ability to request a market adjustment to the rents every single year. So in my particular state where Section 8 is extremely strong, it's as simple as sending a rent increase letter and requesting a rent increase effective 60 days from the date, and it goes to the Section 8 organization, and they typically award you what you ask for. I mean, when I ask for Section 8 rents, because they have the ability to award you 10 to 20% higher than fair market rents, you typically ask for 10 to 20% above FMR or fair market rents. That's what I typically do. And there's also this thing called SMR, standard rents, which is a subcategory within FMRs that allow you to request rents based off the zip codes, because some zip codes offer you higher Section 8 rents than other zip codes based on the demand.
When Section 8 approves that, does the tenant feel that increase, or does Section 8 absorb 100% of the increase?
So in my particular market, the tenant's liability is limited to a percentage, typically 30%. Right.
So if they go up,
in your particular example, most tenants do not absorb the higher increase. Sometimes the rent actually goes down. Their portion of the rent actually goes down. Right.
Okay. Wow. Okay. So we definitely have some work that we've got to do to look into that.
What I would say is every Section 8 organization is different. You want to get in contact with those Section 8 reps. You want to understand, do you guys bump it up normally at fair market rents? Do you have some sort of grid behind the scene that you go off of that's not fair market rents? Every Section 8 organization is different. Like Worcester, Massachusetts, they award us FMRs all day. Right? If I go to New Bedford, where I own another syndication, like they'll limit rents to like $100, $200 below FMR because they have another subcategory behind the scenes, right? I own a 32-unit in Lancaster, South Carolina. They got nowhere. They didn't approve any close to Section 8. They approved 825 when the FMRs were 1,100, right? So you have to understand the market, and you've got to have a conversation with a Section 8 rep to understand, typically, how's this process work, and like how much do you typically award? Do you base it off of FMRs? Do you base it off another type of metric? Like how do you determine, these rent increases? But overall, it's an extremely easy process.
Got it. That's encouraging. I appreciate that insight for sure. A couple other questions. Whenever you're looking for properties, what's some of your criteria? Do you have to buy it at a certain percentage of ARV? You want to make sure that you can BRRRR within a year, within 2 years? Like, what are some of your criteria in terms of deciding, yes, we're going to go through with this property?
So the thing about buying large multis is if it doesn't work on the back of a napkin, it's not going to work in your fancy smancy Excel model with waterfalls and all of that stuff and sensitivity analysis. So when it comes to value add multi, like one of the truest metrics that you should understand is what is your all-in cost per unit, right? So say, for example, I'm buying units at $70,000 a door, and it's going to take $30,000 per door, and that includes CapEx, cosmetic, everything, to get it to market. And those doors normally trade for $130 to $140 on average, right? I'm always looking for a 20 to 30% discount on a price per unit basis based off an all-in cost. Right, that's one of my go-to metrics. Right, if you tell me the price per unit, you tell me the renovation budget, I can give you a price right at the top of my head on kind of what makes sense for me. Another good metric that I like to utilize and find is I like to make sure rents are 30 to 40% depressed based off where they should be. Because if I get the rents up, that's going to allow me to create forced appreciation in the form of increasing the NOI, right? So another aspect I like to look for, at least in my particular market, where interest rates are at, the only way like the cash on cash makes sense is when it's typically 1.2%. You know the 1% rule, the 1.2% rule. So pro forma rents typically have to be at the 1.2% rule based off the purchase price. Like those are some easy metrics that I look for in my particular market. You got to keep in mind the cap rate markets that I play in are between 6.5 and 9.
Yep, that's kind of same for us. We're around 6 and 7% right now. All right, let's just go back real quick to make sure that I took the appropriate notes. 20 to 30% discount of ARV.
20 to 30% discount on a total price per unit. Total price per unit.
And then you want to see 30 to 40% depressed rent rates so that you have some room to increase rents.
Exactly, and they are month to month.
So that you have the opportunity to turn up the rents because the leases
quickly and easily, yes.
Yeah. And then what was the 1.2%? Tell me what that was.
Say, for example, I'm buying a portfolio for $5 million. The 1% rule would say the monthly rent roll in that portfolio is $50,000, right? So if I'm looking at the 1.2% rule based off that $5 million portfolio, that'd be $60,000 rent roll per month. And that's based on pro forma or market, because ultimately all the value add multi I'm buying, the current rents make absolutely no sense. You can't underwrite off current rents. I underwrite based off pro forma rents, and I put enough money in my stabilization plan to get it to pro forma rents within a year. That's how I underwrite my deals.
I got it. Okay, so basically you took the 1% rent rule and made it 1.2%, and it's attached to the pro forma, not as is.
That's exactly correct.
I got it. All right, man. I want to wrap this up and talk about just the vision. Where are you going? How big do you want to grow? What's that look like?
I think my goal is I want to get up to 10,000 doors in 10 years. Help 10,000 people reach financial independence. Travel for 6 months out of the year. Start a family. Like that's some of my big goals.
Very nice. Very nice. And then do you see yourself doing syndications, raising big money like that? Are you going to stay the route of joint ventures and more traditional financing, seller creative financing and things like that?
So a little dirty secret in real estate is in syndications, there's really not that much money, right? It's really good for building credibility. It's really good for building trust. It's really good for making other people money. But when you're syndicating deals, a lot of times you're not going to get paid until year 3 or 5 down the road. So a lot of times you're working for free up until that point, So to that point, I love syndications. They're great. But, I typically prefer to joint venture. It's just a quicker path to stabilization. And it just tends to, it's way easier to stabilize a 6 unit than a 160 unit. I could stabilize a 6 unit in 4 months. Stabilize a 109 unit, that's going to take 1.5 to 2 years, right?
Yeah,
so the velocity of money can go a lot quicker with some of these smaller multis that I like to
for sure. For sure. All right. Last couple questions. GoBundance. You're going to AES in Austin upcoming soon. You have any other input for guys that are out there that might be considering a membership or checking out GoBundance? What has it done for you? Any connections, resources, inspiration, knowledge?
I mean, GoBundance, one conversation made me $250,000. And that was just one conversation that I had with another GoBundance member. Yeah. Somebody like 5 years ahead of me where I wanted to be, owns like a third of $1 billion assets under management. So he's been where I have been, and he is where I want to go. And he had some really fantastic advice that made me $250,000 last year. And that's just one example. So, ultimately, I think GoBundance is a fantastic group. I think if you go into it thinking, what am I going to get out of it rather than what value I can give, it's probably not the right group for you.
Yeah, that's good.
And if you think if you think in monetary value versus relationship value, maybe I'm paying, 10, 12 grand to join this organization, but I gain tens of thousands of dollars in relationship value, it's worth it to me. So
yeah, no doubt.
I think it's a fantastic organization. I highly recommend it.
I love it, man. Where can people find more information out about you? If they have a deal for you, they have capital, they want to partner with you, how can they get in touch with you?
They can find me on Instagram at Investor Freed and Facebook and LinkedIn, Andrew Freed. feel free to reach out. I'm always happy to answer questions and help.
Got it. Dude, this has been great. I have definitely taken 3 or 4 pages of notes. I needed this. Got some nuggets that I'm going to apply, especially with that Section 8 rent increase strategy to help us make our deal over that we're looking at for the 280 unit deals, which would be a substantial addition to us, right? Like it would more than double our portfolio in one fell swoop. So it'd be a big swing.
Before you close, definitely ask them when was the last time they requested a Section 8 rent increase, because it's limited to every year, right? So if they requested it last month, you gotta wait 11 months before you can request it.
Got it. So good. So good. Dude, thank you for your time. If I can do anything for you in South Louisiana, let me know, man. And looking forward to seeing you at the next Go Abundance event.
Likewise. Thank you, Wyatt. I appreciate it.
Awesome, man. Take care.
You too.
Hey guys, Wyatt Graves here. As you know from previous episodes of this show, I'm on a mission to grow a business that has 25,000 doors, a holding company of service-based businesses surrounded by a protective moat of a personal growth and development educational company. With that being said, I am looking for deals, I'm looking for talent, and I'm looking for capital. If you're interested in connecting with me, go to my website, wyattgraves.com. Send us a deal. I will be sure to include you in some way, shape, or form. Whether you're a real estate agent and you want to be my agent, you're welcome to be my agent if you bring the deal to me. If you're not my agent and you bring the deal to me, we will still get you paid somehow, some way. If you want to work inside of our world, then drop me a line, send me an email, connect with me. We're interested in attracting level 5 talent. And then finally, if you are an investor and want to invest your money, not only to get double-digit returns, but also to have real impact inside of the communities as we raise up the level of good life living throughout our properties with our residents, with our employees, with our communities, then I want to connect with you. Go to wyattgraves.com and fill out the contact information, and I will personally be in touch with you so that we can figure out how we can shake the trees together and win together. wyattgraves.com.